everyone. Welcome to the Property Wealth Podcast. We're so glad you're here with us today.
Yeah, it's great to have you join us.
So let's dive right in. Today, we're going to explore something that a lot of folks over 40 are really curious about. Avoiding capital gains on your primary residence when you decide to turn it into a rental property.
Absolutely. It's a big topic, and it can be a bit tricky,
Right, and we'll also touch on some practical strategies for navigating this transition. Plus, we'll discuss how to build long-term wealth through real estate investing.
You want to make sure you walk away with some solid, actionable advice that you can apply right away.
Exactly. We'll talk about the benefits of converting your home to a rental, the tax implications to be aware of, and how to maximize your rental income while minimizing your expenses.
And let's not forget the importance of understanding your local market. That can really make or break your investment.
For sure. So grab a cup of coffee, settle in, and let's get started on this journey into the world of real estate investing.
Sounds good, Sarah. Let's jump right in. Sarah, one of the big reasons why avoiding capital gains taxes on your primary residence is so crucial, especially for those of us over 40, is retirement. At this stage in life, many people are starting to think seriously about how they'll fund their retirement, and real estate can be a powerful tool in that strategy.
Right. And with the economy changing so much, it's not just about having a nest egg. It's about protecting it from inflation, too. Real estate often outpaces inflation, so it's a solid way to ensure your money doesn't lose value over time.
Exactly. I had a client, let's call him Tom, who lived in his home for over 20 years. He was considering selling it and moving into a smaller place. But when we crunched the numbers, we realized that selling would trigger a hefty capital gains tax. Instead, we explored converting his home into a rental property. That way, he could keep the appreciation and avoid those taxes. Plus, he'd have a steady income stream from the rental.
That's a smart move. And I imagine that's something a lot of people don't think about. They might feel like selling is the only way to cash in on their investment.
Absolutely. And that's where the emotional aspect comes in too. For many, their home is more than just an asset. It's a place filled with memories, right? Selling can feel like losing a part of their life, but converting it to a rental allows them to retain that connection while still benefiting financially.
And it's also a great way to set up a legacy for family, isn't it? Instead of just selling and pocketing the cash, they're creating something that can be passed down.
Exactly. When you think about wealth transfer, owning rental properties can provide ongoing income for your loved ones. And it can be a more stable asset compared to stocks or other investments that can fluctuate wildly.
That's so true. And with the current market shifts, where people are looking for more flexible living arrangements, turning a primary residence into a rental property can align perfectly with those trends.
Right? Plus, with more people working remotely, there's a growing demand for rental properties in suburban areas. If your home is in a desirable location, it could be a gold mine.
I can see how that would work, but I'm curious, what about the maintenance side of things? I mean, being a landlord can come with its own set of challenges.
Sure, that's a valid concern. However, many people over 40 have a network of trusted professionals, like contractors and property managers, who can help manage the property. It's about building a team. Plus, if you've lived in the home for a long time, you likely know it inside and out, so you're already a step ahead.
That makes sense. And I think it's also about mindset. Many people at this age start to think about their financial security, and rental income can provide that peace of mind.
Absolutely. I had another client, let's call her Lisa, who was nervous about her financial future after experiencing some market volatility. By converting her home into a rental, she not only created a safety net for herself, but also diversified her portfolio.
That's a great example. And it's amazing how these strategies can empower people, especially when they feel uncertain about the future.
Exactly. It shifts the focus from fear to opportunity. Plus, think about the tax benefits. Rental properties often come with deductions that can help offset income, which is another layer of financial security.
Right, and as we age, we want to ensure we're not just surviving, but thriving. Real estate can be a critical part of that equation.
For sure. And it's not just about today, but also planning for tomorrow. When you think about retirement timelines, having rental income can really change the game. You can enjoy your golden years without worrying too much about monthly expenses.
I love that idea. And let's not forget about the emotional side of it, too. Knowing that you have a steady income from a property can provide a sense of security that's hard to put a price on.
You're spot on. It's not just financial security. It's peace of mind. It's knowing that you've made a smart choice for your future and your family's future.
So, for anyone listening, if they're over 40 and considering their options with their primary residence, it's worth looking into how converting it to a rental could fit into their long-term strategy.
Definitely. And that's what we're going to dive into next. Some core strategies to make this transition seamless and profitable. So let's dive into some practical strategies for avoiding capital gains taxes when you transition your primary residence into a rental property. It's a big deal, right?
Absolutely. I mean, nobody wants to be surprised by a hefty tax bill when they're just trying to invest wisely. So, what's the first thing folks should consider?
Well, the first step is understanding the primary residence exclusion. You can exclude up to $250,000 in capital gains if you're single, or $500,000 if you're married, right? But there are some conditions.
Yeah, I've heard about that. You have to live in the home for at least 2 of the last 5 years before selling it, correct?
Exactly, and that's critical. So if you're thinking about renting it out, you might want to sell it first if you're close to that 2-year mark. Otherwise, you might end up paying taxes on gains that you could have excluded.
Right, but what if someone decides to keep it as a rental?
Good question. If you're holding onto that property after the 2 years, you could still benefit from depreciation. That's a tax deduction that allows you to write off some of the property's value over time.
Oh, that makes sense. So even if you miss the capital gains exclusion, you can still reduce your taxable income because of depreciation?
Exactly. And remember, you can't just take the depreciation on the full market value of the house. It's based on the purchase price minus the land value, typically over 27.5 years for residential properties.
So if someone bought their house for $300,000 but the land is worth $100,000, they'd be depreciating $200,000 over 27.5 years?
You got it. That's about $7, $273 per year in depreciation deductions, which can really help offset your rental income.
Right, so that's a solid strategy. But what other rules of thumb should we keep in mind when evaluating rental properties?
Well, one of my favorites is the 1% rule. Basically, you want to aim for your monthly rent to be at least 1% of the purchase price. So if you buy a property for $200,000, you should be looking to rent it for at least $2,000 a month.
That's a simple way to gauge if a property will cash flow well, huh? What about costs, though?
Great point. You also need to factor in ongoing expenses. The 50% rule is a good one for that. It suggests that about 50% of your rental income will go towards operating expenses, including things like maintenance, property management, and vacancy costs.
So if you're renting that $200,000 property for $2,000 a month, you should expect to spend about $1,000 on those expenses?
Exactly. So if you take the $2,000 rent, subtract that $1,000 for expenses, you're left with $1,000 in cash flow. But then you also need to consider your mortgage payment.
Right, because if your mortgage is $200 a month, you'd actually be negative cash flow, right?
Yes, and that's a crucial part of the evaluation process. You need to run the numbers. It's always about understanding your cash flow.
And what about financing options? I know there are different ways people can finance their rental properties.
Absolutely. Traditional loans are common, but there are also options like FHA loans, which allow lower down payments, or even VA loans for veterans.
And those can be great for first-time investors, right? But what about seasoned investors?
Well, seasoned investors often look at portfolio loans or commercial loans, especially if they have multiple properties. It's all about finding what works best for your financial situation and goals.
That makes sense. I also think it's important to consider the type of property you're investing in. Do you have any advice on that?
Sure. Single-family homes can be easier to manage, but multifamily properties often bring in more consistent cash flow. Like, you might have a 4-unit building, and if one unit is vacant, you still have 3 others bringing in income.
Right. Diversification within one property. But what about markets? Should investors stick to their local area or look elsewhere?
It depends. Local markets can be easier to manage because you know them well, but sometimes You can find better deals in other areas. Just do your due diligence. Look at the job market, population growth, and rental demand.
And speaking of due diligence, that's where a checklist can be very handy, right?
Absolutely. A simple checklist could include things like checking the local rental rates, analyzing the neighborhood's appreciation potential, and looking for any upcoming developments that could affect property values.
So if you're thinking about investing in a new area, you might want to visit it, talk to locals, check out the schools, and see how the community feels.
Exactly. It's all about getting a feel for the place. Plus, understanding zoning laws and any regulations specific to that area is crucial.
Now, let's talk briefly about some common pitfalls. What should people watch out for when making this transition from primary residence to rental?
Well, one of the biggest pitfalls is underestimating expenses. Maintenance costs can really add up, and unexpected repairs can hit your cash flow hard.
Yeah, and I guess if you're not prepared for vacancies, that can be rough too, right?
Absolutely. It's important to have a financial cushion. Also, not doing enough research on the rental market can lead to mispricing your property.
And that can make or break your investment, right?
Definitely. So staying informed and prepared is key.
I love that. This has been super informative. Let's keep this conversation going and explore more about those pitfalls next.
So when we talk about capital gains and transitioning a primary residence into a rental, one of the biggest pitfalls I see is over-leveraging. People get so excited about the potential income that they forget to consider how much debt they're taking on.
Yeah, that's a huge one. It's easy to get swept up in the numbers, thinking, oh, I can afford this property without really looking at the long-term implications, right?
Exactly. I had a client, let's call him Tom. He bought a beautiful home in a great neighborhood, thinking it would be a fantastic rental. He took out a big mortgage, pushed his budget to the limit. But when the market shifted, he found it hard to keep up with the payments.
That must have been stressful for him. So what happened next?
Well, he ended up having to lower the rent to attract tenants, and then, the cash flow just wasn't there. He couldn't cover the mortgage, and it put him in a really tight spot.
That's rough. I think a lot of people underestimate the importance of cash flow when they're getting into rentals.
Totally. You've got to have a clear picture of your expenses. Mortgage, property taxes, maintenance, and, of course, management fees if you're not doing it yourself. It can really add up.
And that leads us to the importance of having a solid tenant screening process. Bad tenants can change everything, can't they?
Oh, absolutely. I remember another client, let's call her Lisa. She was super eager to rent out her property and didn't do a thorough background check on her first tenant.
Uh-oh, what happened?
Well, this tenant ended up being a nightmare. They didn't pay rent on time, and when they finally did, it was often short. Lisa had to deal with late fees and, ultimately, eviction, which is a costly and time-consuming process.
Wow, that sounds like a real headache. So what can listeners do to avoid that situation?
It all comes down to screening, really. Make sure you're checking credit history, employment verification, and even past landlord references. A little diligence up front can save you a lot of trouble down the line.
Right, and it's not just about finding someone who can pay the rent. You want someone who will take care of the property, too.
Exactly. There's also the common mistake of ignoring cash flow. Some investors get so fixated on the property's value appreciation that they forget to look at the day-to-day income and expenses.
You're so right. I think many people assume that real estate is just a set-it-and-forget-it investment.
For sure. I've seen too many people buy a property thinking it will just appreciate over time, only to find that they're bleeding money each month because they didn't account for expenses.
Like what kinds of expenses?
Well, there are the obvious ones, like repairs and maintenance. But then there are also hidden costs, like unexpected vacancies or even legal fees if you end up in a dispute with a tenant.
That makes sense. And speaking of hidden costs, I think a lot of new investors don't realize how important it is to budget for those.
Yeah, it's crucial. I had a client who bought a rental property and thought they could just manage it by themselves. They didn't factor in the costs of repairs and upkeep, and when the roof needed fixing, it hit them like a ton of bricks.
Ouch. That's a tough lesson.
It is. They ended up having to dip into their savings to cover the repairs, which really cut into their cash flow. It's a good reminder that you've got to have a cushion for those unexpected expenses.
Definitely. And that brings us to the idea of timing the market. Trying to buy at the perfect moment.
Ah, yes, that's a classic pitfall. I had one investor, let's call him Mark, who was convinced that he could time the market perfectly. He kept waiting for prices to drop, thinking he'd get a better deal.
And did he?
Not at all. While he was waiting, prices just kept climbing. By the time he made his move, he ended up paying much more than he would have if he just acted sooner.
That's such a common mistake. So, what's your advice on that?
My advice is to focus less on timing the market and more on the fundamentals. Look for properties that have strong cash flow potential, regardless of market fluctuations.
That's a great point. And I think a lot of it comes down to doing your homework and understanding the market you're investing in.
Exactly. Research is key. Know the neighborhood, understand the demand for rentals, and pay attention to local trends.
And if things go south, it's important to have a plan, right?
Absolutely. Being prepared for market downturns or unexpected expenses can really save you in the long run. Keep a reserve fund and don't be afraid to adjust your strategy if necessary.
Such valuable advice, Mike. So, to wrap up this section, what would you say are the key takeaways for our listeners?
Well, avoid over-leveraging, screen your tenants thoroughly, keep an eye on cash flow, budget for hidden costs, and don't try to time the market perfectly. Focus on the fundamentals and stay adaptable.
Great reminders. And I think with those strategies, investors can really set themselves up for long-term success rather than short-term stress.
Exactly, Sarah. It's all about building a solid foundation.
And now that we've covered some common pitfalls, what are the next steps for those looking to move forward?
All right, so let's dive into some actionable steps that listeners can take right now to really get the ball rolling on this whole capital gains thing.
Yeah, absolutely. It's all about taking those first steps, right? What's the first thing they should do?
Well, a good starting point is to evaluate your current situation. You can use tools like Zillow or your local MLS to check the current value of your home. Just get a sense of where you stand.
Right, and knowing that value can really help you understand your potential gains, right?
Exactly. And once you have that number, you can start thinking about what your options are. If you're considering moving to a rental strategy, look at platforms like BiggerPockets or DealCheck to analyze potential investment properties.
Those are great resources. BiggerPockets has so much information, and the community aspect is really encouraging.
Yeah, it's like a treasure trove of knowledge. And speaking of analysis, I always recommend using the BiggerPockets calculator or rentometer to evaluate rental prices in your target area. It's super user-friendly.
Oh, and those calculators can really help you understand your cash flow too, right?
Absolutely. Cash flow is key. You want to ensure that your rental income will cover your expenses. So once you have a potential property in mind, run those numbers and be realistic about expenses like maintenance and management.
That's so true. It's easy to get carried away with the excitement of a new investment.
Exactly, and that's why having a checklist can be so helpful. Start with things like research the market, analyze properties, calculate potential cash flow, and consider financing options.
And once you have that checklist, what's next?
You might want to join a local real estate meetup group or online forums. Connecting with others who are on this journey can provide support and accountability, and you can learn from their experiences.
That sounds really motivating. Plus, you never know when a great opportunity might come from those connections.
Right? It's all about building your network. And don't forget about books and podcasts. There are some fantastic resources out there that can deepen your understanding.
Any favorites you'd recommend?
Well, I always go back to Rich Dad, Poor Dad by Robert Kiyosaki. It's a classic for a reason. Also, the book on rental property investing by Brandon Turner is super practical.
Great suggestions. And for podcasts, I love listening to BiggerPockets podcast for those real-life case studies and insights.
Yes, they really break down deals and share lessons learned, which can be incredibly valuable.
So to recap, we've talked about evaluating your home value, using online tools for property analysis, and the importance of networking. What else can people do to ease into this?
Well, I'd encourage listeners to start small. Maybe analyze one deal a week. It doesn't have to be overwhelming. Just get into the habit of looking at properties, understanding the numbers.
That's such a manageable way to build confidence.
Absolutely. And remember, it's all about starting where you are. Don't feel like you have to jump in with both feet right away.
Right. It's about creating a sustainable habit over time.
And don't forget to set clear goals. What do you want to achieve with your real estate investments? Write those down and revisit them regularly to stay focused.
I love that. Goals can really help shape your path forward.
Exactly. And as you learn and grow, those goals might evolve, and that's totally okay too.
So, with all these tools and habits, listeners are definitely on the right track.
Yeah, and it's exciting to think about where they can go from here. So those are some practical first steps. Now let's bring this all together. Well, Sarah, it's been quite a discussion today about avoiding capital gains taxes when transitioning from a primary residence to a rental property.
Absolutely, Mike. I think one of the biggest takeaways is really understanding the importance of the primary residence exemption. That can save folks a lot when they decide to rent out their home.
Right, and then there's the timeline aspect, too. Keeping that 2 out of 5 year rule in mind is crucial for maximizing those tax benefits.
Definitely. And let's not forget about the importance of proper planning. Having a solid strategy in place can really set you up for success. It's all about being proactive, right?
Exactly. And leveraging that equity to reinvest in more properties can really help build long-term wealth. It's a smart move for anyone looking to grow their portfolio.
For sure. And, it's not just about the numbers. It's about creating a lifestyle and legacy that can benefit you and your family for years to come.
Well said, Sarah. Real estate can be a fantastic vehicle for wealth building, especially for those of us over 40. It's never too late to start or expand your journey in property investing.
And if you found today's episode helpful, we'd love for you to like and subscribe. And don't forget to comment with your biggest takeaway or any questions you might have.
Yeah. And if you know someone over 40 who's thinking about investing in property, share this episode with them. It could make a real difference in their journey.
Next time, we're diving into something exciting. A review of crowdfunding platforms, specifically Fundrise versus Arrived. You won't want to miss it.
Absolutely. Thanks for joining us today. And remember, each step you take in real estate is a step toward building your future.
Take care, everyone. We'll see you next time.